Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us here as we close out the first half of 2023, believe it or not. So we'll join you again next week in July. But for now, we're going to cover a few topics that we covered in this week's investment allocation meeting on Monday. We got four things for you. The first two are in the housing category. Both have some tangent, at least, to inflation. And then Andrew's going to pick it up and discuss the performance of stocks versus bonds and what that might mean for its implications as we turn the quarter. And then lastly, looking at the valuation of those big seven stocks we keep talking about. So let's start off with inflation rent. That is something that, of course, all categories of inflation have been screaming for a while. But the growth in new rents has been declining for a period of time. We're going to throw up on the screen here a period of 6 nationwide views of rents. And you see back in 2022, we were growing at high up into the double digits. That's difficult to sustain. So the first thing to realize is that we're going forward going to be comparing to those new higher marks. So sustaining that, very unlikely. But it is welcome news that the growth rates have at least been coming down. And if you average those 6, we're just now at about 2%. And this is looking at new leases as they're being signed. So it kind of takes out some of the wonkiness of measurements. Now, it takes a little bit of time for that to filter through the way we look at CPI and some of the other national average broader measures of inflation. But this is at least some bit of good news. I don't think anybody expects this to dive headfirst into an outright decline. Like I said, a lot of this is just lapping some of the higher sets and the higher values that were set up in rents. But nevertheless, we'll take the declining numbers we have and something that should at least keep it moderate, even if we do see a rebound in rent, something that should keep it contained. We can see in actually the build out of starts in apartment buildings. And that's our next slide. So there's going to be 2 lines on this chart. The blue are starts. And so here specifically, we're looking at multifamily units. That's just a fancy word for apartments. The blue are the actual, so when you actually dig and begin the construction. And then the red is when it's completed. So there's always going to be somewhat of a lag between those two measures. Take a look at 2020. So we had a couple of things happen. One, we did have a lot of starts coming out of the last several years. But as we dealt with supply chain challenge after supply chain challenge and labor, of course, completions haven't been happening to those units. So we expect in the back half of 2023 for there to be a lot of units delivered to the market, or in other words, a lot of supply. So when you have more supply meeting the demand for apartment units, there should be a moderation in those rent units. So we'll see going forward. And this should actually set the record as expected in 2023 for the most number of apartment buildings delivered to the national housing supply. So something we have been watching and will continue for the rest of this year, not just in terms of potential stock implications, but our broader real estate portfolio as well. Andrew, I'll pass the ball over to you and what you covered with us on Monday with the stock versus bond performance.
Thank you, Adam. As Adam mentioned, we're closing out the end of the month. So we're closing out also the end of the quarter and looking back at the performance of 2 specific asset classes. We're going to look at stocks and bonds. We've seen that stocks have really been able to outperform bonds almost to the degree of 11%. That's what the bottom of this chart shows, looking at a rolling 3-month change in performance, comparing the relative performance of bonds to stocks. So right now, we're as of the end of last week, we were negative 10.7%, meaning stocks were outperforming bonds by just about 11%. Looking back at history, we can find that this is one of the further ends of, we can stretch that proverbial rubber band in relative performance. You can see that outside of really major market events, think the COVID crash in 2020, the financial crisis in 2018, 2019, were really the only times we saw a much larger disparity in performance between bonds and stocks. And why this is significant is that the end of each quarter and months, a lot of institutions and pensions will have a static allocation when they say we want to have 30, 40, 50, whatever percent invested in fixed income. And so when that allocation gets disrupted by a lack of consistent performance that stay in line between bonds and stocks, they have to do a rebalance. And so when it gets to be about 10% difference in performance, we do start to see some possible rebalances as people start selling their stocks to buy bonds, and kind of bringing those allocations more into tolerance. And we have seen several instances where when we get to a 10% spread, that the market does become a little bit more volatile. I've put the dates on this chart. You can see some are red and some are in black. The dates that are in red are when we did see the market begin to pull back a little bit of varying degrees. And then in black, we really didn't get much of a response. The most recent date is one that's going to stand out because it was actually just last year in 2022. In January, we did hit that 10% threshold to start year 2022. And we did see, obviously, equities begin to pull back. Before that, it was actually January again, 2020, right before the COVID crash. 2018, the market was almost going parabolic straight up. Some of you may remember that. The market just really was going strong in November, December, and January, and then January of 18. And then we did have a really quick 10% decline at the start of the year before the market was able to kind of dust itself off and continue to rally. And then there's several other instances there. I won't go through every single one of them, but we do typically see that proverbial rubber band not be able to contract or to try to extend too much further than this. And we do see a little bit of a pullback. And so we recognize that and realize that maybe we're in a point where equities could begin to, once we close out this month and this quarter, could see a little bit of relief rally, maybe in bonds, and maybe see equities pull back a little bit, something for us to be cognizant of as we start off July and start off a new quarter. The last point I wanted to make is a topic that, as Adam said, we have been talking about quite a bit this year, is looking at what's now been dubbed the Magnificent Seven, the very few stocks that really drove the bulk of the gains in the first quarter and a big chunk of the second quarter as well for the large cap S&P 500 index. It was primarily the Apple, Microsoft, Amazon, Google, Teslas, Facebooks, Nvidias. These seven stocks really drove the lion's share of performance. And when we look at it, not so necessarily from a performance standpoint, but looking at it from a valuation standpoint, we can see that they're now trading at a much, much higher value, a much higher multiple relative to the rest of the market. What I mean by that is when we look at the price to earnings ratio. So that's looking at the amount of money they're trading, the number of shares, divided by the earnings that company is able to report. And so we can see the median for those stocks. They're growth stocks, they're tech, they do traditionally trade at a higher premium, higher multiple, but that's been around 24 times earnings. Right now we're at 30, and then compare that to all the other stocks are at 17. So we can see that these seven stocks are trading at a much richer valuation than the rest of the market, and that can introduce some volatility there. Historically, stocks that have very, very high multiples do see a lot of that juice, not a lot left to squeeze from the performance as valuations get a little bit less attractive. Now, this isn't necessarily a timing tool. We can't say just because right when we hit 30, that's when these stocks can no longer continue to rise. Stocks can have a high valuation for a protracted period of time. We can see they were actually up near 35%. You can see on that chart during 20 and 2021, and they were able to continue to have elevated multiples for many months, many years before the market began to essentially try to reprice those, and they began to correct in 2022. So this is something we do want to be wary of, be cautious towards, recognizing that the biggest stocks in the market right now are trading at pretty lofty valuations. And this is something I know Adam pays a lot of attention to, being our CFA on staff, really looking at the financials of those companies, and he does an excellent job with that. But they are trading at much higher levels than we're seeing the rest of the market. Adam, anything else you'd like to add on that point, or this kind of your bailiwick?
No, well, just a couple of things. I mean, so of course I'm watching it, but so is Jay Powell. It's something that's taken a back seat. They do very much carry what's happened in risk markets. They talked more about it in 2022. But the further you see lofty valuations, the more that works itself into their models. I'm not saying it has a big impact right now, but it is a factor. And the second is simply interest rates. Back on the chart there in 2020, 2021, that era, interest rates were still at zero. And so much easier, much harder to have some sort of definition of what is real value when you can't have interest rates or a safe investment alternative. You're willing to reach and pay up. And for the rest of the stock market, I think they've recognized that, and that's probably a big factor why they're closer to their median. But this group has broken away. And as you said, it doesn't mean that they have to collapse. It doesn't mean that it has to happen anytime soon. but it does have a high bar for the earnings to follow through in the coming quarters. So it may very well be the case, and we certainly hope that it does, but it is a factor in our models and something we have to be disciplined and not overexposing ourselves to this group. So that's our mantra. And Andrew, you covered it well. And just in closing, as always, we give you a reminder to reach out and give us a call if we can be of help. 800-928-4001. And thank you all, and hope you have a good weekend.